Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at NIO.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we get into today's stock, here is a useful tool for investors who want a faster and cleaner research workflow. You can check out stockanalysis.com Pro through the link below in the description. Use discount code ITP for 10% off. Stockanalysis.com is lightweight, fast, and works on desktop, iOS, and Android. The free version is useful for checking stock prices, financials, charts, forecasts, and news. But if you want deeper research, stockanalysis.com Pro gives you no ads, saves screeners, watch lists, portfolios, long-term financial history, dividend history, analyst filters, ETF data, and exports to Excel, CSV, and Google Sheets. Pro comes down to about $5.93 per month when billed annually after the discount. For heavier users, the unlimited plan adds unlimited downloads and unlimited stocks per watch list and comes down to about $14.93 per month when billed annually after the discount. Stockanalysis.com is a research tool, not financial advice. It does not tell you what to buy or sell, and it does not guarantee investment results. Always do your own research and make your own investment decisions. This is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
So, we really are standing at this fascinating, almost chaotic intersection with the electric vehicle market right now.
Oh, definitely. It's wild out there.
Yeah, I mean, for you listening, if you've been following the space at all, you know it feels like the Wild West phase is over, that era where money was free and every startup was promised the moon.
Right, that's completely done.
We are firmly entering this era of corporate survival of the fittest, and we've got a lot to cover today. Filings, institutional flow data, upgrades. The mission for our talk today is really to answer one critical question. When an EV giant tries to fundamentally change its entire DNA, how do you know if it's actually working?
Exactly. And that is exactly why this particular company is so compelling today. We are witnessing a massive fundamental inflection point.
Yeah.
Yeah, because for years, their narrative was just typical of the entire sector, right? A high-growth, cash-burning startup prioritizing expansion at literally all costs.
Right, just get the cars on the road.
Exactly. Getting cars on the road was the only metric that mattered. But the internal machinery has fundamentally shifted over the last few quarters. They are actively transitioning into a highly disciplined, efficiency-focused enterprise.
So they're actually caring about the bottom line now.
Yes. The underlying metrics are finally proving that they care about profitability, not just top-line revenue.
I hear the optimism. I really do.
Oh.
But I have to play devil's advocate for the listener here, especially looking at how the market actually reacted recently.
Fair enough. The reaction was brutal.
Right. Following their latest financial results, we saw a really sharp, painful retreat in the stock price.
Yeah.
The market clearly just fixated on their weak forward guidance. And let's be honest, there is a broader macroeconomic malaise dragging down the entire Chinese EV sector right now. So when you see a post-earnings plunge like that, the immediate question is, are we trying to catch a falling knife here?
That's the million-dollar question.
Or is this genuinely, the messy, unloved beginning of a true operational turnaround? But before we can figure that out, we need to understand the broader strategy.
All right, let's move into the wealth building context.
Let's do it.
Because, when we step back from the daily ticker tape and that immediate panic of a post-earnings drop, we have to evaluate where a company like this fits into a multi-year portfolio strategy.
Right, zooming out.
Exactly. If you are a long-term investor, the daily volatility isn't your primary concern. Structural advantages. And they matter for a long-term portfolio precisely because of their premium brand positioning.
Okay, premium brand.
Yeah. Think about what is happening in the lower tier and mid-tier EV market right now. We are seeing just brutal, unrelenting commoditization.
Break that down for us, actually. When you say commoditization in the context of EVs, what does that actually look like, say, on the dealership floor?
It basically looks like a race to the bottom. In those lower tiers, a car is just a battery and four wheels to the consumer.
Right. There's no loyalty.
Zero brand loyalty. So competitors are forced into these brutal price wars. Everyone is slashing prices just to move metal off the lot. And in doing so, they're actively destroying their own profitability.
Like a game of chicken.
Exactly. It's a game of chicken where nobody wins. But by firmly anchoring themselves as a premium luxury brand, this company is deeply insulated from that race to the bottom.
Okay, I see.
You don't see luxury watchmakers slashing prices by 40% to compete with budget brands, right? It's the exact same logic. They're preserving their pricing power while their competitors just bleed.
And it dictates a totally different capital allocation strategy, too. Like, instead of trying to artificially prop up the stock in the short term by returning capital via buybacks or dividends.
Which honestly wouldn't make sense at this growth stage anyway.
No, not at all. But instead of doing that, they are aggressively reinvesting into an infrastructure mode. They're building out their sub-brands to capture more of the market. It's almost like an early auto company insisting on building its own nationwide network of gas stations before trying to turn a massive profit on the actual cars.
That is a perfect analogy.
Right. Yes, it requires heavy upfront cash, but it creates an incredibly sticky ecosystem. You aren't just selling a vehicle, you are locking a consumer into your proprietary network for a decade.
And that ecosystem lock-in is the holy grail of consumer retention. I mean, once a driver is integrated into that network, the psychological and financial friction required to leave and go to a competitor is massive.
Absolutely massive.
But to see if that ecosystem strategy is actually paying off, we have to look at the hard data.
Now let's look at the fundamentals.
I love getting into the numbers.
Yeah, because this is where the narrative really flips from speculative hype to quantifiable reality, right?
Absolutely. The star statistic from the recent data, the one that completely validates their strategic shift away from growth at all costs, is that Q1 vehicle margins surged to 18.8%.
Wait, 18.8%?
Yeah.
For anyone listening who doesn't track automotive manufacturing every single day, why is that number such a showstopper?
Because it is an incredibly difficult number to achieve, and it's practically unheard of for a young company in this current macroeconomic environment.
Right. Autos are notoriously low margin.
Famously low margin. To hit nearly 19% places them at the absolute high end of their startup EV peers. It is the definitive mathematical proof that their internal cost-cutting initiatives, their deep supply chain optimizations, and most importantly, their premium pricing strategies are actually working.
Wow.
They aren't just selling cars at a loss to juice delivery numbers anymore. They are selling cars profitably.
But profitability on a spreadsheet doesn't guarantee survival if the runway's too short.
Very true.
So let's ground this conversation for the listener. What are you seeing when you dig into the actual filings?
Well, if you look at the 2025 filings, specifically the annual and quarterly reports, the balance sheet tells a story of profound resilience.
Okay, lay it on us.
They hold roughly $6.2 billion. That's about 45 billion yuan in consolidated cash, restricted cash, and short-term investments.
Let's unpack that because I hear dilution risk thrown around a lot when we talk about EV startups.
Oh, constantly.
So for the listener trying to protect their portfolio, what exactly happens when a company gets desperate for cash? And why is that $6.2 billion so critical?
Well, dilution is the silent killer of portfolios. Imagine a pizza cut into 8 slices.
Okay, making me hungry, but go on.
Right. Well, if a company runs out of money, they essentially issue more shares to raise capital. They cut that exact same pizza into 16 slices.
So the size of the company didn't grow.
Nope, the size stays the same, but your individual slice just got cut in half. Your equity value is destroyed. In an environment where borrowing capital from banks is incredibly expensive due to high interest rates, having $6.2 billion in the bank is huge.
It's a massive safety net.
It allows them to execute this operational turnaround without that suffocating threat of shareholder dilution. That risk is actively forcing lesser capitalized peers to issue stock at depressed prices just to keep the lights on.
And they're taking that massive cash pile and using it to deepen what has to be their ultimate competitive moat, right? Their battery as a service boss and their automated battery swapping network.
Yes, the battery swapping is key.
But explain the mechanics of this, because it is a radical departure from the traditional plug-in charging model we see literally everywhere else. How does it actually change consumer behavior?
Well, think about the biggest psychological barrier to electric vehicle adoption for the average consumer.
Range anxiety.
Range anxiety and charging wait times. With the battery swapping network, a driver just pulls into a station and an automated system physically